All right, welcome to Iron Financial. This is where we forge stronger portfolios by smashing through all the market noise. And today, we are breaking down Coherent Corp. Look, the company just dropped some really strong earnings, but the stock, it dipped. Wall Street seems completely lost. But you know what? We see a massive disconnect between the headlines and the actual hard numbers. And a disconnect like that, well, that usually smells like a big opportunity. So we're going to drill down, get into the filings, the conference call, and figure out if Coherent's foundation is built on solid steel or if the market is actually right to be seeing cracks. Let's get into it.
Okay, hold on a second. This is the part that drives me crazy. The headlines are all saying favorable results, but the stock goes down. That just doesn't compute. Wall Street is literally telling me to be happy with the numbers, but at the same time be really worried about the margins. That is the definition of a mixed signal. And that kind of stuff makes me nervous. What are they seeing that I'm not? Or is this just the market doing what it does best and completely overreacting? You're telling me there's an opportunity here, but from where I'm sitting, all I'm seeing is a whole lot of confusion.
And that right there, that's the absolute core question we are going to hammer on today. Is the market's reaction a legit sign of some kind of real structural weakness, actual cracks in the foundation that justify this dip? Or is the market just looking at the surface, getting spooked by its own shadow and completely missing the detailed architectural blueprint that shows exactly how this company is being rebuilt for some pretty massive growth? We're going to dig into the data, layer by layer, and we're going to find the real story.
So let's start where you always have to start. The foundation. For any business, that's revenue. It's the top line. If you don't have a solid, growing top line, nothing else you do even matters. The whole building is resting on it. So let's get the heavy machinery out and let's really examine the strength of Coherent's revenue growth. Are we looking at solid bedrock here, or is it starting to show some signs of crumbling?
Okay, so look at these numbers, because at first glance, they tell a really interesting story. For the full fiscal year 2025, Coherent brings in $5.81 billion in revenue. That's a huge 23% jump year over year. That is a powerful growth story right there. But then you look at the most recent quarter, Q2 of fiscal 2026. Revenue was still strong, $1.69 billion, but that year-over-year growth number, it clocked in at 17%. And that difference, that little drop from 23 to 17, that's exactly what's making the market so uneasy right now.
Whoa, wait a minute. Let's just hold on here. You're showing me a number that went from 23% growth down to 17% growth. Basic math tells me that's a slowdown. That's a deceleration. It looks like the engine is sputtering a little. Is this the first real crack in the armor we're seeing? Is the whole growth story starting to get a little bit weaker? Before we talk about anything else, we have to get to the bottom of this. We got to strip this thing down to the studs and see what's really going on under the paint.
You know what? That is exactly the right question to ask. And this number, 22%, is the answer. That 17% headline figure you see, it's misleading. It's what we call a noisy number. Why? Well, because during that time, Coherent made a strategic move and sold off its aerospace and defense business. So you're not even comparing apples to apples. When we adjust for that sale, when we look at the pro forma numbers for the core business, the real year-over-year revenue growth for the quarter wasn't 17%, it was 22%. So let me be clear, the growth isn't slowing down. When you look at the actual operational structure, it's accelerating.
And here's the most crucial part. Where is that acceleration actually coming from? Well, it's being driven by an absolute monster of a growth engine. Just look at this number, 34%. That is the year-over-year revenue growth in their data center and communications segment for this past quarter. Come on, this isn't just healthy growth. This is explosive, AI-fueled demand that is literally pulling the entire company forward with it. This is the high-octane fuel in the tank, and the pedal is to the floor.
And this chart just brilliantly illustrates how dominant that engine has really become. Take a look at the revenue breakdown for the quarter. That data center and communications segment, it brought in $1.2 billion. Their other big division, the industrial segment, brought in $478 million. So you see, this isn't some small, fast-growing piece of the business anymore. This is the business. It is the primary load-bearing wall holding up the entire structure, and it is growing at a blistering pace. The foundation isn't just solid, it's being reinforced by the single most powerful trend in technology today, artificial intelligence.
Okay, so we've established it. The revenue foundation is not only strong, it's accelerating. So let's move up the structure to the next level, profitability. A building can have a massive foundation, but if the floors above it are weak and they're just losing money, the whole thing is going to collapse eventually. Coherent has been in a phase of some pretty heavy construction, so let's see if they finally turn the corner from just pouring concrete to actually building a profitable skyscraper.
Now this right here, this slide shows a turnaround that is nothing short of monumental. For the entire fiscal year of 2025, the company posted a GAAP loss of 52 cents per share. They were in the red. Now fast forward to this latest quarter, Q2 of fiscal 26, and they delivered a GAAP profit of 76 cents per share. This isn't just a small step into the black, it's a giant leap. They've gone from losing money over a full year to generating a significant profit in just one single quarter. The structure is no longer leaking cash, it's actually generating it.
Okay, I see the profit. A profit is great. Nobody's going to argue with that. But let's circle back to the original complaint from Wall Street. They were underwhelmed by the margins. It's one thing to show a profit, sure, but it's a whole other thing to show a high-quality, durable profit. Is this real strength, or is this whole thing just built on sand? Are these margins paper thin? Are they at risk of just collapsing the second a little headwind blows? You need to prove to me that this profitability is as strong as that headline number makes it sound.
That's an excellent challenge. And it really gets to the heart of this disconnect. You see, the market is addicted to sugar highs. They want to see these massive, explosive, often unsustainable jumps in margin. But that is not how you build a structure that lasts. Coherent is playing a different game entirely. They're playing the game of methodical, disciplined strengthening. Look at the non-GAAP gross margin progression. In Q4 of fiscal 25, it was 38.1%. 2 quarters later, it's at 39%. This is not a wild jump. It is a steady, deliberate, methodical climb. Every single quarter, they are reinforcing the structure, adding another steel beam, making it a little stronger, a little more profitable. This isn't weakness. This is the signature of disciplined, world-class operational execution.
And you have to understand, that margin improvement is not some happy accident. It's the direct result of a very clear, very deliberate strategy. This is exactly how they are engineering a more profitable company. First, they are streamlining their entire portfolio. They're divesting non-core assets like that Munich tools business, which we know operated at lower margins than the rest of the company, so getting rid of it immediately helps the average. Second, they are cutting operational fat. They have exited 33, let me say that again, 33 underutilized sites in just the last year and a half. That is a massive reduction in fixed costs. And finally, they're taking the cash from these sales and they're paying down debt. That directly reduces their interest expense, which lets more profit fall straight to the bottom line. Every single one of these actions is a calculated move to reinforce this company's financial structure.
So the foundation is solid, the existing structure is profitable, and it's actually getting stronger by the quarter. But here at Iron Financial, we don't just invest in what a company is today, we invest in what it's been engineered to become tomorrow. We need to see the blueprints. We need to see the plans for future expansion. What's the plan to build the next 10, 20, 30 floors on top of this already strong base? Let's take a look at their forward-looking plans.
Now listen, this is not a quote from some analyst trying to make a name for himself. This is a direct statement from the CEO, Jim Anderson, on the official company earnings call. Read that again. He expects their fiscal 2027 growth to exceed their fiscal 2026 growth. In a world where most companies are constantly guiding down and trying to manage expectations lower, this is a statement of extreme confidence. The chief architect of the entire company is on the record telling the market that not only is growth strong now, it's about to get even stronger.
Talk is one thing, but numbers are everything. So what's backing up all that confidence? This number. In the data center segment, the core engine of the entire company, their book-to-bill ratio was greater than 4-to-1. Let me just explain what that means, because it is absolutely staggering. For every $1 of product they shipped and billed in the quarter, they got more than $4 in brand new orders for the future. Demand isn't just outpacing supply, it is completely overwhelming it. This is a tidal wave of demand coming from the hyperscalers building out AI infrastructure, and Coherent is standing right in the middle of it, ready to deliver. And that incredible demand is for their next-generation technology. They have a crystal-clear roadmap to capture all of it. The ramp for their 1.6 terabit transceivers, which is the next big leap in data speed, is happening in 2 clear phases. The first wave is already underway, driven by their existing platforms. But the second, even bigger wave is coming in the second half of this year, powered by their new 200G VCSEL technology. Now that stands for Vertical Cavity Surface Emitting Laser. Basically, it's a key component that lets them move data faster and more efficiently at a lower cost. This isn't just some hope for future business. This is a detailed product-level plan to meet the demand that their 4x book-to-bill ratio proves is already knocking down their door.
And what's really critical here is that they are not a one-trick pony. Beyond that massive transceiver business, they're constructing entirely new pillars for growth. Their optical circuit switch, or OCS business, which is a much more efficient way to route huge amounts of data in a data center, has a growing backlog, and they're already engaged with over 10 customers. They just secured a landmark large purchase order for co-packaged optics, CPO, that's the cutting-edge tech of putting the optics and the chip in the same package for insane performance, from a leading AI player. And on top of all that, their more traditional data center interconnect and telecom businesses are also seeing broad-based demand. They are building a diversified, multi-pillar structure for future growth, not just betting on one thing.
All right, we've inspected the foundation, we've stress-tested the existing structure. We have reviewed the blueprints for future expansion. We've examined the revenue, we've examined the margins, and we've examined the forward-looking demand. It is time to put it all together and deliver the final, decisive iron financial verdict. So, after all of that drilling down, this is what it all comes down to. We saw the stock dip, we heard the market's concerns about these underwhelming margins and slowing growth, we've looked at all the counterarguments. So what's the final call? For an investor looking at this stock today, is Coherent an opportunity that's just hidden by some short-term noise, or is it a value trap just waiting to spring on anyone who's not paying attention?
So this slide just lays it all out, right here, side by side. The market sees what it thinks are cracks. It sees underwhelming margin growth. Our analysis shows a deliberate, strategic margin expansion plan that is already working. The market sees slowing headline revenue. Our analysis, when you strip out the noise, uncovered accelerating core revenue of 22%. The market reacts to a post-earnings stock dip and a bunch of analyst uncertainty. We see the hard data. Overwhelming demand, proven by a greater than 4-to-1 book-to-bill ratio, and clear, concrete blueprints for future growth, with their 1.60 roadmap and new wins in OCS and CPO. The market is looking at the cracks in the paint, while we've been busy analyzing the structural steel underneath.
So the verdict is in. Coherent is a reinforced structure, and it is engineered for significant growth. The market's concerns are based on a surface-level, frankly lazy reading of the numbers. They are mistaking deliberate, disciplined construction for weakness. The noise you're hearing, the dip in the stock, all the analyst hand-wringing, in our view, it is nothing more than a distraction. The underlying data reveals a company with accelerating core growth, systematically improving profitability, and a book of business that points to an even stronger future. The market is creating a blind spot, and for investors who can see the blueprint, that is exactly where opportunity is forged.
So we'll leave you with this one final thought. Based on our deep dive into all the source material, the question really isn't about Coherent's structural integrity. The evidence for that is, frankly, compelling. The real question is about investor fortitude. It's about you. Are you disciplined enough to ignore the short-term market noise and trust the underlying financial data? Can you see the blueprint for the skyscraper while everyone else is distracted by a little crack in the sidewalk? That's the challenge. And that's what separates forging a truly strong portfolio from just following the herd off a cliff.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.